Hello everyone, welcome to YouTube channel. In this video we're going to talk about chapter 4 assignment for chapter 15. In this assignment we have two problems, one for treasury stock and one for a comprehensive problem on equity transactions. So let's take a look at first one, the equity transaction. All right. So we start with a company with the following balance sheet equities. We have common stock, paid-in capital, and retained earnings. Par value is $10 per share. Then in transaction A, the company bought 380 shares of treasury stock at $48 per share. Right, this one's pretty easy to work on. Right, basically we're gonna debit treasury stock, right, based on the purchase price. This is cost method, right? 380 shares multiplied by 48. And then we're gonna credit cash, right? Then transaction B, about 300 shares again. So we're going to repeat the same journal entry. Now we're going to debit treasury stock 300 shares multiplied by $54. Credit cash $16,020. All right, so now we're going to check our treasury stock warehouse. We have 380 shares at $48 and then 300 shares at $54. Okay. Now in transaction C, we sold 320 shares at $50 per share. Applying FIFO is going to give us a cost of this sale should be $48, right? Because this came in first, and we do have enough so-called inventory. All right, so we're going to credit cash for this sale, 320 shares at $50. We're going to measure the cost of the sale, treasury stock. Okay, 320 shares multiplied by $48 per share because of the FIFO assumptions. You see, we are losing $2 per share, no, we are not losing. We are selling above the cost. We're earning $2 per share, right? And this is going to increase the paid-in capital from treasury stock account, or $640. And after these transactions, we check the treasury stock warehouse. We should have 60 shares left at $48, and we still have 300 shares at $54. All right. And finally, we sold 120 shares, $45 per share, debit cash for this transaction. And we're going to determine the cost of the sale. Cost of the sale, treasury stock. Then we're starting with the 60 at 48, but that's not enough, right? We need another 60 shares at $54 per share. So this is going to give us the cost of this transaction, $6,120. Cash received, you do the calculation, is $5,040. Right, let's do the calculation. It looks like we're losing money. How much we have lost in this transaction? Right, we lost $720. So we're going to reduce our equities by $720. The first choice is this account, paid in capital from treasury stock. But it has only $640 balance. So we're going to debit paid in capital from treasury stock. The maximum amount we may debit will be $640. And we need to reduce $720, so we're going to debit the remaining balance from retained earnings. That's $80. All right, so we finished all the transactions. And part E, how many shares are outstanding now? So we're going to update our treasury stock after transaction D. After transaction D, we should have 220 shares left, right, at 54. So how many shares outstanding? Shares outstanding equals what? Equals shares issued, right? Shares issued minus the number of treasury stock. So shares issued, we're going to check the common stock account and par value. Right, we have to issue right $27,000 to get that balance, then minus the remaining treasury stock, 220 shares. No, it's not too. Let me see. No, I made a mistake right here. We sold 60. Right? We sold 60 at 54. So we should have 240 shares left. Okay, 240 shares left after transaction D. So we're gonna minus 240, and this is gonna give us 26,760 shares outstanding by the end of the period. All right, this answers question 1. Now let's move to question 2. So let's see question 2. Right, a company received the right to issue stock. So these are their transactions, right? Let's see what kind of transaction do they have. January the 8th, they issued common stock, $18 per share, and February the 1st, issued preferred stock in exchange for some assets. July the 29th, purchased treasury stock. August the 10th, sold treasury stock. December 15th, declared 10% stock dividend. And December 31st, declared cash dividend, common stock, and also declared preferred dividend. Then December 31st, close the account. All right. So let's record these journal entries one by one. So January the 8th, what happened is we issued 2,000 shares common stock, $18 per share. So this is a typical issuing stock journal entry. So we debit cash, multiply by 18. So we get cash $360,000, and we gonna credit common stock. Remember, we're gonna record par value into this account. So that's 20,000 shares multiplied by par value. Let's check par value for common stock. Right here, right? It's information. $10 per share for common stock. and the par value for preferred stock will be $50 per share. And the remaining balance will be recorded additional paid-in capital account. All right. So February the 1st, we issue preferred stock in exchange for assets. Now, issued 5,000 shares preferred stock in exchange for assets with equipment, right, building, and land. All have their fair values, but we don't have the market price for our preferred stocks. Therefore, in this exchange, the value of the transaction is determined by the assets received. Okay? So we can debit all the assets received at their fair values. And we're going to credit, right, the issuing preferred stocks. This follows the common stock, the same thing. We're going to credit preferred stock. Okay, this records the par value of this issuance. You know, it's $50 per share multiplied by 5,000 shares. And the rest is credit into additional paid-in capital, preferred. Now we're going to do a calculation. That's a total debit minus the preferred stock. This is $50,000. So we're going to credit additional paid-in capital preferred, $245,000. July 29th, purchase treasury stock, $19 per share. Now this is very straightforward. That's a debit treasury stock. At their purchase cost. And then we're going to credit cash. August the 10th, sold treasury stock at $14 per share. And because we have only one treasury stock in our warehouse, so we don't have to worry about FIFO. The cost will be $19. We are selling below the cost. Therefore, we're gonna, because we don't have any paid-in capital from treasury stock account credit balance to use, we have to reduce our retained earnings in this case. That's $5 per share. All right. Now come to the most important part. December 15, we start to issue stocks. First, we issue 10% stock dividend. When the stock price is $58 per share, because the 10% stock dividend is a small stock dividend, so we're going to use the fair value of the stocks to measure the transaction. And also, we're going to issue 10% stock dividend based on what? It's 10% based on shares outstanding. So we need to figure out how many shares are outstanding before we do the calculation. Well, let's check. Okay, we issued transaction 1. Let me see. Transaction 1, we issued right 20,000 shares. Then July the 29th, we repurchased. Then August 10th, we sold. Therefore, if we do the calculation, we should have 19,800 shares outstanding. And we're going to issue 10% on that. So we're going to issue new shares, 1,980 shares. We're going to issue these amount new shares. Now we can do the journal entry. So we're going to debit retained earnings. Right, it's funded by retained earnings. Multiply by the stock price at the issuance date. If it's a large stock dividend, then we're going to use a par value. Right? On the credit side, we're going to credit common stock because it's declared and the shares are issued, so we don't have to go through the common stock dividend distributable account, then convert that to common stock. We can just credit common stock, which records a par value of this issuance. Right, $10 per share, and the rest is recorded additional paid in capital account. All right. Then what else? December 31st, declared a quarter per share cash dividend on the common stock, and also declared preferred dividend. So again, we're going to check how many shares outstanding, because all the cash dividends are based on shares outstanding. So after December 15 transaction, right, we will have these many common stock outstanding. Right? Remember, this is a 10% stock dividend. Therefore, if we do the calculation, then we should have $21,780 shares, and each share we're going to give them quarter. That's $5,045. That's for common stock. And also we're going to declare dividend for preferred stock. Preferred stock is based on shares issued multiplied by the par value, $50, and multiplied by the payout ratio, 14%. Right, this is going to give us the preferred dividend, $35,000. Therefore, the total dividend we're going to declare debit retained earnings. These numbers together is going to be $40,145. And we're going to credit dividend payable. All right? And the final journal entry is a closing journal entry. Right? We're going to close our retained earnings to income summary. So what is my ending retained earnings? What is my ending retained earnings? We have to figure out what is my ending retained earnings. So we start with, because this is the first year of operations, we don't have other data. So we can just check how many retained earnings do we have. Okay, we have one credit to retained earnings. Next, retained earnings, another debit. Another one. All these are debit to retained earnings. Okay, and when we close, we're gonna close net income. We're gonna close net income to retained earnings and go to income summary. And this is on the credit side. And all the transactions we're gonna close on the debit side. We're gonna post the debit side. All right. So in this transaction, we're gonna close all the net income to retained earnings, then into income summary. Therefore, the journal entries we're gonna debit income summary. And credit retained earnings. Alright, so we finished all the journal entry. And the final step is to update the balance sheet presentation. Alright, so we're going to report a common stock, right? Common stock, basically $10 par. And we have 50,000 shares authorized. And how many shares issued and how many shares outstanding. Okay? You need to figure out by yourself. Then we're going to report also the same thing, preferred stock. Again, the same thing, shares authorized, issued, and outstanding, because there's no treasury stock for preferred stock in this case. And we're going to report all the paid-in capital. Additional paid-in capital, we have common. Additional paid-in capital, preferred. Right? We're going to report retained earnings. Right? We just posted a credit. Then we also need to account for those debit, and we're going to have retained earnings and imbalance. Also, we have some treasury stock left, so we're going to less the treasury stock. How many shares, at what cost, and this amount will be subtracted. And finally, we're going to get a total stockholders' equity, and we can solve this problem.